Well, for more on China's financial reforms, I spoke with David Dollar. He's a senior fellow in the John L. Thornton China Center at the Brookings Institution. I started by asking about efforts to tame financial risks in China.
First, as Governor Zhou Shuachuan said, he called the China monetary policy prudent. But frankly, I think there'll be a little bit of tightening. The target for the growth of M2 is a little bit slower this year than last year. So they're gradually tightening monetary policy. And as Governor Zhou said, the idea there is that you've got some Chinese companies that are really in poor condition. They have too much debt, and you don't want to make things too easy on them. Some of them probably need to go bankrupt or restructure. So they want to make sure there's a tight enough budget constraint to support that restructuring. And then on the other hand, you've got the rise of shadow banking. You mentioned Guo Shuqing as the new banking regulator. He's already indicated he wants the banks to pull more of the wealth management products onto their balance sheets. So he's looking at pulling in some of the shadow banking activity and regulating it under the banking system.
Now, touching on the banking sector, what are some of the biggest risks that still remain, and how imminent are they?
Well, I think risks are building up, but I don't see any imminent crisis, so I think the officials had the right tone. They need to move to deal with these. The biggest risk is probably lack of coordination among the different regulators. You've got different types of financial products in China that are subject to different regulators. We had this problem in the United States. We call it regulatory arbitrage. Your firm tries to find the best sub-market to operate in where there's the least regulation. So you need to coordinate and make sure that all the similar products have similar regulations so that nobody is missed from that net.
And as we look at some of the risks in asset management problems, how concerned should investors be?
I think investors should be concerned because those products say clearly that the principal is not guaranteed. And I think households are assuming that because they're sold by a big bank with a reputable name, they're assuming it's guaranteed, but it says clearly that it's not. There have been a couple of these products that have gone bankrupt over the last year or so, so you have to be prudent. They pay higher interest rates because they are somewhat risky, and households need to take that into account.
Now, corporate debt obviously still an issue. So in terms of efforts to really reduce the leverage of corporations, how effective have those measures been so far?
Well, I think they're really just starting. The leverage keeps going up in the corporate sector. The best you could say is that the rate of growth has slowed down. Governor Zhou referred to deleveraging as a medium-term objective, so I think this is what the authorities want. If you do it too abruptly, then the economy slows down sharply. They certainly don't want that. So they're betting that they can gradually rein in the growth of credit and get leverage to slow its growth and eventually stabilize. It's probably going to work, but it does take those measures we talked about in terms of tightening credit, in terms of stronger supervision to actually get that outcome.
Now, China was better insulated than others when it came to the global financial crisis. So what can China learn perhaps from past financial crises in the US and other countries as applicable to China?
Well, I think the U.S. has two powerful lessons. The first is we did a very poor job regulating shadow banking. We have very tight regulation of commercial banks, but we assume that other financial institutions could do risky things, and if they went bankrupt, well, that's capitalism. But it turned out things were much more interconnected. So I think tight regulation of shadow banking is important. And then related to that, you have to make sure the financial institutions have enough capital. We had too much leverage in our financial institutions. They were playing with people's money, and when things went bad, they had to be bailed out. So you want to make sure the financial institutions have enough capital so that if things start to go south, it's the investors and the banks who lose out because this is a risky system. You don't want your depositors to lose out.